Welcome to this explainer. Today, we're taking a comprehensive and honestly somewhat complex financial management playbook and translating it into the actual practical tools you need to grow a business. Look, whether you're an aspiring finance manager or a business owner yourself, mastering corporate wealth really just boils down to a specific set of rules, models, and strategies. So let's get right into it.
Okay, let's kick things off by asking the absolute most fundamental question, the one that should drive literally every single decision a finance manager makes. Now, if you ask a random person on the street, they might tell you the goal is just to, maximize profits or slash expenses or push sales volume. But in the world of corporate finance, the true goal is actually far more specific.
Our true North Star here isn't just about minimizing expenses or chasing those quick short-term profits. It is all about maximizing shareholder wealth. According to our playbook, this means one very specific thing: maximizing the value of the firm's common stock. Every investment, every loan, every daily operational choice, it's all weighed on a scale against this single metric. If an action doesn't enhance shareholder value, well, we simply don't do it. To achieve this wealth maximization, we're going to break this playbook down into 5 core phases. 1, the ultimate financial goal. 2, making investment decisions. 3, funding the business. 4, the dividend dilemma. And 5, managing daily operations.
Starting right off with Section 1, the ultimate financial goal.
Before we can make any big strategic moves, we have to establish the foundational principle of all financial valuation, the time value of money. Simply put, a dollar today is worth more than that exact same dollar a year from now. Why? Because today's dollar can be invested and start earning a return right this very second. This concept is exactly why we use mathematical processes like discounting to figure out what a pile of future cash is actually worth to us today. And this time value totally dictates how money grows. Think about it like this. Simple interest is kind of like pushing a heavy cart up a hill. It just plods along constantly, growing based only on the initial principal amount. But compound interest? That is a rocket ship. It builds exponentially because you're earning interest on the principal and on all that accrued interest. Getting that exponential growth engine running is absolutely crucial to maximizing a firm's long-term value.
Moving on to Section 2, making investment decisions.
So imagine you're deciding whether to buy some expensive new machinery or expand your warehouse or maybe launch a completely new product line. How do you scientifically prove it's actually going to add value to the business? We can't just guess. We need rock-solid metrics to evaluate these long-term capital budgeting decisions. Let's break down the 3 main tools we use to evaluate this. First up is the payback period. This basically just tells you how many years it'll take to get your initial investment back. It's super simple, yeah, but it completely ignores that time value of money we just talked about. Next, we have the internal rate of return, or IRR. This is the discount rate where your project basically breaks even in today's dollars. But a quick warning, complex cash flows can actually spit out multiple totally confusing IRRs. Finally, we get to net present value, or NPV. This one explicitly considers the time value of money. If a project has a positive NPV, it is actively creating wealth for the company today. Because of that, NPV is considered the absolute gold standard.
Okay, part 3, funding the business.
So, you found a wildly profitable project using NPV. Great. Now, how do you actually pay for it? The golden rule here is that your project's return absolutely must be higher than your WACC. That's your weighted average cost of capital. WACC essentially blends together the cost of your debt and the cost of your equity. If your shiny new project can't generate a return that clears this WACC hurdle, you are literally destroying wealth, not creating it. The ultimate goal here is to structure your capital to keep that WACC as low as humanly possible. Which brings us to the double-edged sword of leverage. Our playbook requires us to manage risk by understanding 2 very distinct levers. First, operating leverage. This is driven by your fixed versus variable costs. It's how a tiny change in sales volume can crank the gears to create a massive impact on your operating profit. Then there's financial leverage, which focuses on your debt levels. It uses borrowed money to magnify those operating profits into even larger earnings per share. But hey, be incredibly careful here. While financial leverage magnifies your profits during the good times, it works like a heavy anchor in the bad times, equally magnifying your risk of going bankrupt. Depending on the stability of a company's cash flows, a manager has to choose a capital structure. A horizontal structure, for example, relies entirely on equity and retained earnings. It's incredibly low risk, sure, but it really limits the capital you have on hand for massive projects. On the flip side, you have the inverted pyramid structure, which relies heavily on debt. Now, debt has some sweet tax benefits that lower your overall cost of capital, but balancing on that tiny point comes with a very high, looming risk of bankruptcy if things go south. That brings us to Section 4, the dividend dilemma. All right, so your project succeeded and you actually made a profit. Do you reinvest that cash or do you pay it out to your shareholders? Well, the theoretical world is split into three fascinating camps on this. First, the Gordon growth model, which values a stock assuming dividends will just grow at a constant rate forever. Then there's Walter's model. This one takes a very practical angle. It compares your cost of capital to your investment return. Basically, if the firm can generate higher returns internally, you should keep the money. The optimal payout is literally 0%. And finally, we have the Modigliani-Miller or irrelevance theory. They argue that in a perfect, tax-free market, dividends don't even impact firm value because investors can just buy and sell stock to create their own desired cash flow.
But, we don't live in a theoretically perfect market, do we? In the real world, a manager's dividend policy is a delicate balancing act influenced by very practical factors. A high-growth tech startup might retain all its earnings to fund crazy expansion. Other companies have to look at their actual physical bank accounts. Because you can't pay a cash dividend if you don't have liquid cash, no matter what your on-paper accounting profits say. You constantly have to balance the shareholders' hunger for current income today with the company's need to fund highly profitable future investments.
Finally, we arrive at Section 5, managing daily operations.
Let's step away from the grand long-term strategy for a minute. How does a finance manager actually keep the lights on today? It all comes down to this simple formula: current assets minus current liabilities. This gives us our working capital. Think of it like a giant bucket of water. If more water is flowing out than flowing in, your working capital turns negative, and you're going to really struggle to pay your immediate, short-term bills. Positive working capital is the absolute lifeblood of day-to-day survival. And a massive part of managing that bucket is what's called the cash conversion cycle. This is that grueling waiting period between the moment you pay your suppliers for raw materials and the moment you finally receive cash from your own customers. Just imagine your precious cash physically trapped in a warehouse full of unsold inventory. Shrinking this cycle down, meaning getting cash in the door way faster than it leaks out, is pretty much a finance manager's daily obsession. To prevent cash from just getting stuck in that warehouse, managers use this exact formula: the economic order quantity, or EOQ. It might look a bit intimidating, but it's incredibly useful. It mathematically calculates the absolute perfect sweet spot, balancing the cost of placing new orders against the cost of storing excess inventory. It guarantees you order just enough to meet customer demand without hoarding all your cash in the form of boxes sitting on a shelf. And once you make the sale, you have to actually collect the cash you're owed. Extending credit to customers definitely boosts sales, but you have to rigorously evaluate them first using the 5 C's of credit, things like character, capacity, and capital. And to speed up that collection process, you might offer specific credit terms like 3, 10, net 30. This basically means you give the customer a nice 3% discount if they pay within 10 days. Otherwise, the whole shebang is due in 30 days. It's essentially a strategic little bribe to minimize bad debts and speed up your cash cycle. So, what does this all mean? As we wrap up this playbook, I want to leave you with this ultimate balancing act. On one hand, you are tasked with aggressively maximizing shareholder wealth, making massive long-term investments, and maybe even taking on risky debt. But on the exact same day, you have to ruthlessly manage your working capital just to ensure you have the liquidity to keep the lights on tomorrow. How do you weigh the pursuit of massive long-term wealth against the harsh reality of daily survival? Well, mastering that tension is exactly what makes a truly great finance manager.